Go ahead.
Great. Perfect. Thank you, Julian. Thank you to everyone else being here for this for the next 30 minutes. My name is Paul. I'm one of the co-founders and CEO of Finexity AG. We've just been listed on the Munich Stock Exchange on the 5th of September, and I founded the company back in 2018. And I'm really looking forward to taking you onto a journey now to explain a bit more about the company, where we stand, and our strategic approach for the next 3 to 5 midterm targets. Um, this is not moving now. Here we go. A lot of you may have not heard about Finexity before, so I'm going to give you a small introduction. We have a big vision. We want to drive opportunities in private markets. Now, that could mean everything, but also nothing. So what does that mean for us as a company? For us as a company, driving opportunities in private markets means creating the leading exchange for digital assets. Now, there is two big words in here that I want to discuss a bit further during the next 30 minutes. It's an exchange for digital assets. We're not talking about crypto, but we're talking about tokenization. Now, a lot of you may have heard about tokenization, but what that really means to us is another story. We believe that tokenization deserves a new exchange structure that allows a scalable DLT-based trading platform where regulated securities can be traded. So what in the end we are really building is another exchange for the private markets rather than the public markets. So we don't trade public equities or publicly traded bonds. However, we focus on private market investment opportunities such as real estate, private credit, private debt, infrastructure, or collectibles. And we are focusing on asset classes that need massive transparency, they need improved liquidity, but also we're taking away the settlement risk that is inherent in all securities trading infrastructure processes up to date. Now, as I previously mentioned, I founded the company in June 2018. The company went live at the end of 2019 after we've reconciled with the German regulator, the German Financial Conduct Authority, in short, the BaFin, for around a year, reconciling on both the infrastructure level, but also on the product level. Over the years, we've raised over 25 million in gross capital from both strategic investors, financial investors, but also typical venture capital. We've got 5 different locations. We're based out of Germany. That's where our headquarters is, in Hamburg. We have another office in Switzerland, in Liechtenstein, but we're also based out of the Middle East, in particular Abu Dhabi as well as Dubai. Now, over the years, we've raised money from over 100 strategic shareholders, and they've really helped us grow the company as it is today. And also, most of them have signed, or the significant proportion of them have signed lockup agreements for the next 24 months, which enables us to really make sure that they all stand behind the company for the next months, as they all believe in the larger vision. Now, we believe in organic growth, but we also believe in inorganic growth. And why we believe in inorganic growth is something that I will get to in a second. But with our recent transaction, which is currently in the ownership control procedure because it's a regulated institution in Germany, Effecta, we will increase our registered investor base to around 84,000 clients, retail as well as professional. We don't deal with institutional at the minute on our platform, so it's solely focused retail and professional. We will have increased our pro forma revenue on a consolidated basis to around 6.9 million euros in the financial year 2024. And we will also add more distribution power to our platform infrastructure / our exchange by adding another 45 tied agents. Now, these are the most important facts of the company. However, the reason why we do this and why we as a company were actually founded and why we wake up every day to make this happen shows the following chart. Now, a lot of you are very, very familiar because you're active in the public equity space or public market space. You're very familiar with the Markowitz portfolio from 1952. 60-40 allocation across equities and bonds. The problem hereby is that allocation doesn't really work anymore today. If you want to increase your Sharpe ratio, reduce risk, but also increase your potential returns, you need to also start investing in private markets. Now, private markets are very, very difficult to actually get into if you are a retail investor. Even for a lot of professional investors, the private market space is still relatively new because it's inherently been driven by institutional money, which means you need a curated, regulated access to private market opportunities. Alternative investment funds, back in the days, they used to work, they don't really work anymore. Now we've got LTIFs coming into play. They've not really performed great either so far in terms of adoption rates, in terms of mass marketing. So we believe that the vehicle that should be used is the tokenization. And with that, we're opening up the whole private market space in a curated, best execution order possible. Now, why is tokenization necessary for this? And a lot of people say, well, tokenization is just a buzzword, but what does tokenization mean for us and how is it really changing the financial industry? Now you see Robinhood. Robinhood said by 2030, most of the stocks will be tokenized. The CEO of DECA, he's also said that he believes that most of the stocks and bonds in the future up until 2030 will be tokenized as well. And the reason being is that through tokenization, we can save tremendous amounts of money by tokenizing regulated securities. We're not creating anything that's unregulated, solely focusing on securities that are structured under the securities law, under MiFID law, that meet all regulatory requirements. And those we take, but we don't conventionally securitize them, but we tokenize them, list it on our exchange, and then trade them, as well as provide all the settlement services. This will allow us to save around 4.1 to 4.6 billion euros in 2030 and then per year expected onwards. Now, those are big numbers. What do they really mean? And where do we save the money in comparison to a conventional trading system? Now, the five key factors that define a trade is the clearing, the settlement, the custody expenses, asset servicing, as well as the inherent risk premium, because transactions in Europe are settled T+2. So it takes 48 hours for a transaction to be settled. You sell me a stock. Yes, we go through our brokers. We are connected to an exchange, but it still takes 48 hours for me to be the righteous owner and for the transaction to be settled. Now, that is changing massively through the blockchain. Through the blockchain, you and me can trade peer-to-peer. No intermediary is required anymore, and the settlement can be done in seconds, if not milliseconds. We've been doing this since 2020. Our secondary market was launched in June 2021. We were the first ones in Europe to create an OTC secondary market for tokenized securities, and it's been up and running ever since. Now, the clearing expenses will therefore be completely eliminated up until 2030. Settlement expenses, we're moving away from T+2 or even sometimes T+3 in Europe. America, they're already at 2.1, at T+1, but we are really changing that to T+0. That will also allow us to change more settlement expenses in the future. Custody expenses will also be changed. Why? Because we don't have any manual labor work required anymore when I custodize a security. And the reason being is that through the blockchain, I'm able to create what is called smart contracts. Smart contracts are in the end intelligent code written by intelligent people that allow us to then have governance on the securities in itself. So we don't need to go back and forth with people, align with people, get clearance from people. Everything is governed through the code in itself. Asset servicing. So when we now look at the issuances that we have listed on our exchange, none of them really require any more manual labor work when it comes to, for instance, paying out interest payments. We have investors, they're onboarded, either it's natural people, natural persons, or it's entities. We can gather all their tax factors, and then we have a direct connection to the tax authorities. We call whether they are part of the church, for instance, and then everything is being calculated straight away, 100% digitally and manually, which allows the issuer to really focus on its core business. And now through the disintermediation that we have throughout our system, we are significantly reducing the risk premiums involved in every single conventional securities transaction. In the future, if there is no intermediary anymore, I don't need to pay for any premiums concerning the risk that in the end the T+2 will fail or settlement cannot be done, which means that we're eliminating all risk premiums that will come up to around 1.9 billion by 2030. Now you see that, yes, tokenization is a big word, but it really provides a solid foundations to create a new capital market, especially for the private market space where retail investors and professional investors really didn't have access to up until today. Now, where do we stand across our journey? Of course, we want to create the leading exchange for tokenized private market investments. So far, we've got over 250 listings on our exchange from over 50 different issuers across 4 different asset classes. They're all listed on our exchange. And then we have a direct brokerage as well, where we distribute on a primary as well as secondary market basis to retail and professional clients. However, the predominant traffic on our exchange comes through external trading partners. And those we split into enterprise, SaaS software as a service companies, and small, medium-sized business software as a service companies. Enterprise for us is banks. So we have banks that are connected to our infrastructure. So for instance, we work with, let's say, a fund, and a fund wants to diversify their product offering, maybe make it a bit more retail-like. They come to us, we advise, we structure if they want, we do the legal transactional management. It's then listed on our exchange, and then it can be brokered and distributed to retail clients, for instance, through a bank that is connected to our exchange. But it can also be distributed via asset managers or other investment intermediaries. The prerequisite, obviously, they have to be regulated with under the right regulation in order to then distribute that security, but we also have an SMB SaaS solution for that. So in total, we're catering pro forma on a consolidated basis, 84,000 registered investors through our platform. Now, the 4 asset classes that we operate in are corporate. So what do we define as corporate? It's private equity, private debt, venture capital, real estate, it's residential, commercial, healthcare, hospitality, infrastructure, renewables. So for instance, solar parks, we're yet to step into transportation, but it's something that we're actively working on, and then collectibles as well. So what you see with all these 4 different asset classes is that there's not a single exchange out there that provides you with a liquid investment in any of these asset classes, and that's what we're here to change. You may ask yourself, what kind of securities are being traded on your platform? Now, generally speaking, by law, and back in the days when we founded the company in mid-2018, there was no regulation. So when I first spoke to the BaFin, and I was like, okay, guys, this is what I believe we should be doing. This is how the securitization space is going to change. They thought that I'm crazy. Now, seven years down the line, regulation has been very, very progressive in Europe. It allows us to not only tokenize debt vehicles, but it also would allow us to tokenize equity vehicles. We can tokenize shares today under German regulation. We can tokenize UCITS, so funds. So all of that can be tokenized. For us as a platform as of today, the 250 different securities that are listed with us, they're all debt focused at the moment. Why? Because we've always been a specialist in providing debt in comparison to equity, because the equity regulation only came in later. But this is something that we're also actively working on to then expand our exchange offering to also equity participations on the exchange. Now, also through the regulation, on the debt side, it can be mezzanine, it can be junior, which means it's non-subordinated and non-secured, but it can also be senior, so secured. So what we've seen a lot in the market is, for instance, small, medium-sized enterprises that are coming to us because we've created awareness amongst them through 1 or 2 fundings, and they said, well, how can you help me find alternative funding sources, because banks are becoming very restrictive. And that is obviously a major change in the market that we've seen since 2022, is that because banks are becoming more restrictive, private debt in itself is becoming a big asset class. And we've really taken advantage of that in the last couple of years to focus on private debt. We're very, very different to a lot of other fintechs. Now, you think raising 25 million is a lot of money. And yes, it is. However, on the other hand, we operate in a regulated space, which means that for us, whatever we do, regulation comes first. However, then when we spoke to the BaFin, they said, okay, you can do what you wanted to do, and that's why we launched in 2019. The biggest problem was we always had the vision of creating an exchange. If I want to create an exchange, I need supply and demand, and I need that in equilibrium. So the biggest problem back then in the days was that I reached out to fund managers and I told them, like, guys, I think tokenization is the way forward. This will streamline a lot of your processes. You can cut your OPEX, increase your margins. There's a lot of free pressure on you anyway. And they said, Paul, this sounds all great, if you can make it legally work, we would love to explore it. However, please make sure that you have the distribution power in place, because there's no point me thinking about something, understanding it, investing time and material into something, then you list a security on your exchange, but no one's buying it. So who's buying it? And then I went off to banks and I told them, or asset managers, other financial intermediaries, and I told them, if I have a couple of issuers, they are all qualified issuers. We've curated them. Don't you want to start distributing their tokenized securities to your investors as you would today anyway? And then they said, how many securities do you have listed? I said, well, none, because they are waiting for you to come on board. And they said, well, no, we're waiting for them to come on board. So it really was the big chicken and egg problem. And that's why we built our exchange from the ground up. So what did we do? We launched our own securitization vehicles. So we set up SPVs, we bought real estate, we got senior loans from the bank. We then issued a subordinated bond on the SPV level, listed it on our exchange, and then started distributing it to our own retail investors. And then after 2 years, the first bank came to us and said, wow, what you're doing is quite impressive. How can we be part of this ecosystem? And that really allowed us in 2022 to open up our ecosystem. And now, as I said, we work with external issuers. We don't really do our own issuances anymore because it's very time intensive. Margins are great, but we really want scalability in our business model. So we work with external issuers. They're qualified. We help them advise, structure, list, and then on the other hand, banks and other asset managers distribute them to their clients. And now we're entering the third stage. And if you remember, I said our exchange has been structured as an OTC platform. Now, we really want to upgrade this because volume is increasing. We want to upgrade that from an OTC to an MTF structure. MTF structure is a multilateral trading facility, which allows us to, regulatory-wise, increase our regulatory filings, make it more institutional bulletproof, but also on the other hand, thereby also increase liquidity and transparency. Now, the reason why we're doing is that because our industry is expected to grow 60% year on year up until 2030. And the larger the volumes, the more liquidity can be provided. And we believe that the MTF, including post-trade services, is the right way forward. So that's one of our 3 strategic pillars for the future. Now, what services do we provide? As I said, we have a very strong capital market solution team. We advise issuers, we do the legal transactional management, but we also do the brokerage. So we can always have investor access, whenever someone comes to us and we believe in the project after our due diligence process. But really the game changer for us is the exchange solution. We have the technological proprietary infrastructure that is built in-house, where we also sit on the IP, the holding company that allows the listing, the tokenization of securities, has got the asset servicing, so tax reporting and filing. We've built the software as a service model for banks, so they're connected to our exchange. We charge them on a monthly basis, but we also make money on a transaction base. We have the small, medium-sized business SaaS for investment brokers, and we're also working on an API access once we turn from an OTC to an MTF platform. Now, this is what looks like. Now, this is what the issuer perspective, for instance, looks like. You can see that I get an overview of all the different securities that I have with Finexity. I can see what current funding status I have. I can manage my investors, and the same applies for the trading partners. So as I said, the major hubs that we've built is with the savings bank, and with the savings bank, we are also doing a online bank integration, which means that the investors can directly through their online banking put in orders that will then be executed on our exchange, which is great because that will be rolled out in the savings bank organization, and then also with the Volksbank, we also have them onboarded on our exchange. And then we have small, medium-sized trading partners that are just coming into play to also broker for, let's say, smaller investor groups. The end investor, unless they are connected, for instance, as is in the savings bank examples, through the online banking, always has access to, through the trading partner, to the assets, and there you can see how it's being traded, what it looks like, the portfolio overview, the cash management, everything is built in-house. Of course, we also partner with other regulated institutions that are providing certain services for us. But in the end, we've created one proprietary software that allows the trading and settlement of tokenized securities, in particular focused on private markets. We have, as I said, we were just listed in Munich in the MXS segment, and 16% of the of the total outstanding number of shares are still directly or indirectly owned by myself. 25% is with co-founders and management. Then we've got one anchor investor, so he doesn't count the free float, 8.8%, and then we've got 50.2% in other shareholders that own less than 5%. We have a very global investor base, and we're here to scale both organically but also inorganically. Now, first pillar, you understood, we're going to turn our OTC into an MTF, and we'll be applying for the MTF license until the end of this year. What does it look like from a financial point of view? Organic growth, this is just our core business without buying any other companies. Revenue in 2024 increased from around 2 million to around 3 million. This was still EBITDA negative in that year. On an inorganic growth path, because we bought a Swiss firm, one of the key players from the Swiss market when it comes to tokenization, plus the regulated securities trading firm in Germany, Effecta, the investment firm Effecta. And with them, pro forma on a consolidated basis, revenue will increase to around 6.9 million, or would have increased to 6.9 million euros in 2024, with still a slight EBITDA loss. What are we looking at long term? What are our long-term or midterm strategic targets? From a non-financial perspective, OTC to MTF, inorganic growth with a clear M&A strategy that we will execute on a technological base. So we're focusing on companies that are EBITDA positive, that will provide technical services to our group infrastructure across the value chain of tokenized security. So those could be, for instance, other distribution companies. Those could be custodians. Those could be registration companies. Those could be listing agents. Anyone that really sits on the value chain of a tokenized security. That's the second part. And the third part is international expansion. And that will we classify mostly as organic growth. And that's why we also stepped into the market in the Middle East. And we've just launched the first tokenized security that allows German investors to invest into the Dubai real estate market in a German regulated way. So that's pretty new. Plus, by Q1 2026, we will also be launching the first institutional and professional funds in the Middle East that will allow us to increase our capital market solution revenue. 70% of total revenue will be coming from the exchange solutions, because that's a really scalable business. We sit in the middle. We have qualified issuers. We have trading partners. We have the same business model as any other exchange. And when you look at exchanges, the EBITDA margins sit usually between 50 to 55%. However, our focus market is not public equities, anything publicly traded, but really focused on private markets across those four asset classes. Our team got 4 board members. Myself, Michael Ost, 32 years, Deutsche Bank, former deputy CEO of BHV Bausparkasse, around 50 billion assets under management. And before then, he was managing the whole private client side for Deutsche Bank out of Frankfurt. That included both retail as well as private banking. We have Tim Janssens, our CTO, who's been in the blockchain space since 2014. And then we have Sindra. Sindra is a trained investment banker and has had a couple of years in private equity and has worked on many IPOs. And Sindra and me were predominantly responsible for anything M&A related for the firm. Now, last but not least, 20 seconds, we have a proven business model. Profitability complements scalability. Yes, we might not be EBITDA positive yet. However, growth rates are significant. We're targeting a $1 trillion market. We really act local, but we think global. We have international business. We have a strong founder and shareholder alignment. We hold more than 40% of the company. We have a 30 months lockup period, which means that we are really aligned to this firm. We believe in this firm, and we have a very diverse management with a strong track record. These are our offices, and I thank you very much for your participation and listening to me. Thank you.
Well, thank you very much for the great presentation, Paul. This is a very, very interesting sector in which you are right now with the Tokyo conferences. It's all about tokenization. I mean, a lot is happening in that sphere, and there's going to be a lot of new players coming in, and that brings me to the first question that we have. So basically, someone asked, what are the other big traditional exchange companies planning in regards of tokenization assets, and why would you, as a small player, do better than the competitors?
Very good question. Number one, all the big exchanges are at least thinking about it. Some of it have already made it public that they're going to be, at least through a subsidiary, be focusing on tokenization. So for instance, Deutsche Börse, they've issued something that they will be running a tokenized exchange as well. The difference really is, number one, I don't want to compete with the big players because the big players are going to be focusing on the tokenization of public equity, because that's a big difference when you look at the slide where we talked about the cost savings. So for them, it's really, again, scalability. They're focusing on public equities. For us, we're in a market that we really understand from the ground up, and it's private markets. Now, private markets, you need to cater the issuers in a different way. It's a different industry, and they've never really worked on the public market side. And that's why we believe, by creating an exchange that's not in competition with the larger players on a technological base, yes, but not on an asset base, where we can really drill down the market, create a leading exchange for tokenized private markets. And then later on, there could be possibly a good target for a larger firm to also potentially buy out.
And one more question on the subject. I think it's going to be the last question. We saw in July, Japan again, the really big real estate company that went out with what they called a tokenization project of real estate. What's the difference does it make for you guys to be in the sector, to be present, to develop that for years now, versus guys coming in and jumping on the train that's already going full speed?
Yeah. 95, I would say 95 to 99% of the companies that I've seen in the last, or since 2018, have come and gone. And they are not in the market anymore, because you really need to build traction on your exchange. If you don't build traction, it's nice to tokenize something, but tokenization in itself is just another way of securitization. So the technology in the end can be copied and pasted. What cannot be copied and pasted is your infrastructure that combines all the different services, from advisory to structuring, legal, transactional, that combining with the technical infrastructure, including custody, settlement, and so on a regulatory base. So we believe that we are opening up our infrastructure. We're an open infrastructure. Anyone can use us. You can be connected. And I think that's the way forward, because that's what we really see in the market, that's what drives growth in our market, is creating an open infrastructure that people can use, where transaction expense or transaction costs are low, and where you provide great liquidity in something that is really illiquid.
I think this sums it up. Paul, that was a great presentation. Maybe one last little comparison from my side. It's the same thing as a sport club or a sports league. If no one's watching, if no one's attending, well, then you build the stadium for nothing. So the key part of it is to have people on both sides coming, the buyers and the seller, and this is exactly where the money is made. So thank you very
Correct.
much, Paul. We'll be
Thank
following your
you.
story with great interest, and see you next time, maybe. Thank you,
Thank you
Paul.
very much. Thank you.